Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the announcement late Thursday that Trump has directed Fannie and Freddie to buy $200 billion in mortgage-backed securities to push mortgage rates lower. This is a special breaking episode, and I want to thank our sponsor, Trust and Will, for making it possible. Logan, welcome back to this special edition podcast.
Yes, just about before I was about to go on stage today, we get the news that Trump announced that Freddie and Fannie authorized $200 billion worth of purchase. I think I might be wrong here. They've already done like 50 or 70 billion already. So I don't know if there's only 130 billion left on the cap. I might be completely wrong here because it's been a while since I've looked at what their charter was on this. But if I'm right, they still have like 150 or 130 billion left to purchase off of that. If that's true, then of course mortgage-backed securities got a little bit better right off the news. Let's bring some context into this discussion.
Let's bring some context because what people really care about, I think, is like, what does this mean for mortgage rates?
So the spreads were already getting better. We're only 20 to 40 basis points away from normal. This isn't like the QE where we're spending trillions of dollars of buying bonds and mortgage-backed securities. So it's not going to be that type of mortgage market response. You know, my first inclination is this is also somewhat of a defensive move as well because rates are near 6%. This prevents rates from really breaking up higher in 2026. Spreads get improved unless the labor data starts to get really better and wage growth picks up and unemployment. This keeps rates lower for longer. A year ago, you and I talked about this, like what can they do? The Fed's not going to buy mortgage-backed securities, but if they wanted to, you know, they could have Freddie and Fannie take their excess profits and buy, but I don't know if that's in the works with the IPO or anything like that. If they wanted to, on top of this, they could make some changes on LPAs, or as Pulte calls it, pricing, on top of this as well. Again, there's a lot of things going on, midterm elections here. You know, tax cuts are coming, oil prices are low. They want lower mortgage. Remember the whole trinity we talked about in November of 2024, lower oil prices, lower mortgage rates, and a lower dollar. And looks like there's going to be a big push on this going into the midterms. It's funny because in the earlier podcast, we said now that they're trying to ban investors or institutional investors, there has to be a demand side equation to this, right? So expect something, and within hours, something was announced.
This is crazy. Yeah. I think it's interesting because you did say in different podcasts, you've been like, they could change this in a second if they wanted to.
They can change it via a sentence anytime they wanted to. Well, that, a lot of that was the Fed. If the Fed really wanted to, they could change things but just the headline of this happening can get it. Now, I just want to make sure there's context into this. Spreads improving as they are. If it does occur with the mortgage-backed security market, this will be to me like a 2026 story. I don't think this is going to be like policy every year, but just for this year, it does keep rates lower, especially if the 10-year yield is lower. Now you have a better chance of it getting a little bit better out there. Again, we've not had a sub 6% mortgage market world here. So again, always work off the slow dance, the 10-year yield, 30-year mortgage rate. I mean, by the time this podcast comes out, we're going to have Jobs Friday out there. We'll see how the bond market reacts to this. But think of this also as putting some protection onto the upside, making sure rates stay lower. Don't think of this as kind of QE where we're just going to trillions of dollars of quantitative easing and bond buying and mortgage-backed securities and stuff. It's not going to be that. To me, it's just extra insurance to keep things intact going into the midterms.
Well, let's talk a little bit about specifics, like, what happened right after and what do you expect to happen with spreads when you're like, okay, they're going to get a little bit better. So does that mean 20 basis points? Does that mean,
Well,
what do you mean?
we'll see how the market reacts to this and the 10-year yield. There isn't kind of a full, the mortgage market is 100% all spreads. There is a difference out here. To me, again, it's just, when in 2024, when bond yields were rising and the 10-year yield spreads were getting better, it limited the damage to a degree, or in 2025. So think of it as that. But again, if you can get the 10-year yield lower now with spreads, what do we say with that? What was the term that we've used in the last few years? You get the double whammy.
The double
Right?
whammy.
The
Yeah.
whole double whammy in this, you get better spreads and lower yields. There's your sub 6% mortgage rates. Now, what I've always said, it's really hard for me to get below 5.75 because spreads have to get normal. If spreads just get to normal 20 to 40 basis points today, you're at 5.80 to 6% already without any help from the 10-year yield. So take a deep breath. I know the headline was crazy, and I know a lot of people are making. We were on stage with the Romneys, and trying to talk about this, but again, it's midterms coming up, and they're going to do whatever they can to try to get this going. And lower mortgage rates was something that was policy here. Because if more people buy homes, more people move, all this stuff, people feel better. And one of the problems with having policy restrictive for housing for so long is that we did this podcast last year. Eventually, government's going to step in and do something about it. And I always said the Fed never read the room as good as they thought. Trump does. So they're putting it, guns of Navarone, everything goes in out there. This is a more beneficial housing topic than banning institutional investors.
Right. It will have more of an effect. So I don't really have any context myself for like 200 billion. So is that like, and you're saying, listen, this is not like QE where it went on and on, or
just the headline of that. Yeah, just the spreads were getting better on their own anyway. Right? The spreads were getting better we were almost back to normal without this. And then you add this onto the variable. It makes it hard for spreads to go higher. So again, remember the Ghostbuster theme we had? Lenny, all those voters you're going to save. Mortgage rates go lower. Again, that's something that the Biden administration had to deal with higher rates. And was very negative for American households. Now, lower rates, lower energy prices. What do we say? Those are two things that people see. What they pay for gasoline, and now mortgage rates lower, and people go, a little bit more buying, a little bit more moving. You get things going, and that's kind of how we've done things in America for a very long time. So Trump reads the room better than Powell and others. So this is it's not a coincidence. This is all happening kind of all at once, right? And we kind of go with that and see what the market implications are.
What kind of, how long lasting is something like this effect on the spreads?
Again, the main point is spreads got better on their own. This is just another factor to help it go a little bit lower. And also on the days where bond yields go up, this is a very good defensive mechanism here to keep spreads limiting the damage on the upside as well. So hypothetically speaking, let's say jobs data is good, unemployment rate goes down, wage growth picks up, bond yields go up. The spreads limit the damage to a degree as well. So it takes that other variable out of the equation about higher rates and what can happen with demand, because you keep that lower rate theory in there. Of course, if the 10-year yield shoots right up higher, there's only so much the spreads can help out. Again, the slow dance is there, but yeah, we talked about this in the earlier podcast today. Now that they did that can't be the housing plan. They have to do something on the demand side. Builder stocks improved today because I think everyone in the market read the room. There's going to be something on the demand side, and it wasn't that long that they announced something to that nature. And then we have the new Fed chairman coming. Fed governors may be getting fired, whatever it is. Part of the 2025 or 2026 forecast with the X variable, the government X variable that, this year is going to be different than the others, and here we are. We've already had 2 announcements and the Venezuela situation. So nothing's normal, Wheeler. Nothing is normal, and this is going to be
That's why we're doing another podcast almost 6 at night, just because we're like we can't let this go unanswered, and unanswered over the weekend. We're like we have to do something.
It can't go answered, but let me give you all something here. Hold on one second.
Oh, this will be good for our people who are watching on YouTube. If you're not watching on YouTube, don't worry. I will describe this to you, but it is it's pretty great. So we're at
You want to talk about timing on things? I'm in Utah, and Utah has a funny sense of humor. They got me peanut butter, Fannie Mae's original recipe, mortgage spreads. So, yes. I mean, come on. And then the news came, So I got to tell you, man, I have not had peanut butter for a very long time. And oh my God, mortgage spreads taste a lot better today.
Okay, we'll end it there. Thanks for jumping on for a quick message here, Logan. And of course, we have 2 tomorrow then that are coming out, or 2 today when this comes out. We'll talk to you.
And it's Jobs Friday, and I'm flying to Boise in the morning to talk. Man,
it's crazy.
No, chart daddy doctrine is in full effect, baby.
Oh gosh. All right. Thank you again. Bye.